This podcast is for educational purposes only and doesn't consider your personal circumstances.
Welcome back to Total Money Management. We're back on, this will be the second to last episode, I think.
Oh, it will be,
a
yes.
special coming out.
Yes.
But we're hanging the boots up here in Paddington and we're moving studios.
An undisclosed location.
We can't tell you.
A penthouse
It's
somewhere.
it's on Mars with Elon.
It's next to the data centres.
Yeah.
We've got an offer.
Yeah.
And
Have we matched?
No, Tom's
Mine
let the team
doesn't fit.
down.
You're too swole.
I'm too fat.
Oh, right. So Jacob and I have worn the not all heroes wear cape.
Yeah. And it's timely, hey.
It is.
What's
absolutely.
cape this week?
41 and a half, I think. Jesus. Yep, 41 and a half.
Yikes.
It's crazy.
The ASX, just quietly, has been doing my head in for the last couple of...
It's weird, isn't it? It's weird.
I was getting hopeful for a bit.
Yeah, it's just going sideways. Yeah. But I must admit, there's days like today, like the US went down a lot last night, and today I thought, we'll get belted today. And it wasn't actually that bad. It was 0.4 or something. So
Yeah, it started down.
No, it started
bit
up, I think.
At one point I was down a bit.
Yeah,
recovered
but
a fair bit.
it opened up 0.2, and I thought, it'll probably go down a lot. But, 0.4 is not much.
Yeah. I think it went up a few percent and then lost it all last week.
Yeah, it's just trading sideways.
Yeah.
But like you say, it's really there's been a couple of days this week where I've just thought I'm not even looking at it.
Well, it's hard to
It's just like I can't be bothered.
I mean, we're the first point we're talking about, again, just quickly touching on war negotiations, but it's with most of our market being commodities and export, it's hard to price in at the minute with the war going on, and is the Strait open or is it not? So people kind of buy and sell.
It's a weird thing, because the oil price has collapsed, as they say, 30%, which is really, it is big. It is a big decline. It's now back to the pre-war levels, but it just strikes me as being really weird. And this is what we were saying off air before, Jacob. This is what triggered me about the short-term thinking. And what oil's a good example. The long-term, the next 6 months for oil is still really murky. Right? Like we still got to get, they're getting 7 ships out of the Strait of Hormuz and it's like, yay. And it's like, dude, we normally get 120 a day.
The other day.
Yeah, it's not as though supply's guaranteed now.
Yeah, it's like, oh my God, we're flooding the market.
But the Bowsers cooled off too.
Yeah. And so, I mean, I drove Brisbane, I drove past my local, it was $1.55.
Yeah, cheap as.
Mind you, the government is still subsidising it.
At 20 odd cents.
Yeah. So there's that. But I was thinking, the point I wanted to sort of say was everybody seems to be thinking short term. It's sort of a little bit like, there's probably not a lot of thinking going on. I think the markets, and this is like all markets are just, they seem to be this wild momentum. Like the oil price shoots up, which was, relatively justified, but then it collapses when I would argue that it's not completely going back to normal.
It's still uncertain.
Absolutely. Yeah. And that it seems to me that everybody's gone, all right, war's over, cool, done, right, oil back to 70, let's all go back to normal. And it's like, come on, guys, I don't think we're there yet.
Yeah,
but
it's completely irrational.
It just seems to be happening with everything.
Yeah. Well, you look at, if you zoom out, the last 4 weeks, you go, probably last month or two anyway, you got the SpaceX IPO and the absolute nonsense that's gone on there. If we look at Australia, what's happening here, those changes to CGT and the effects that could potentially have on the property market as well. AI, obviously that bubble looks like it's still reaching the upper limits.
Yeah. It's interesting, but I was looking at my Instagram feed and looking at the property guys about Albo's tax.
What are they going?
Oh, mate. I'm amazed no one's actually, threatened to kill him or something.
Well, they're words we don't say on this podcast.
Apoplectic.
Some of the people on socials are using bad words.
Oh, they?
Yeah. Oh, yeah. Like I said, there was one guy that every third word was F, right? And it was just this absolute rant about about, the tax changes and they've ruined young Australians' opportunities, and all this sort of stuff, right?
Young Australians' opportunities went out the window about 20 years ago.
Yeah.
with John Howard.
To be fair, it does make, making a business a lot harder.
Well, it does make... my argument, Tom, is it doesn't make making a business much harder. What it does is it makes...
building equity in the company less worthwhile.
Yeah, yes and no. I mean, as I said, I think it was last week, I said, well, prior to these changes in 2000, right, well, people built companies. Do you know what I mean? Like, when I was a kid, there were companies and people would start companies and all that. No one ever went, oh, my God, I'm not building a company. I've got to pay all this tax. It's the issue again where people are always, there's heaps of property people on Twitter who are going, for the last 2 years, right? One guy in particular, right, even wrote a book about it and was like, the government have got to fix this housing market. It's really terrible. It's a bubble, blah, blah, blah. Okay, Albo comes out and says, yeah, cool, we hear you. He's now on Twitter complaining about the changes.
He's on the other side. Well, everyone's got something to flog. That's why.
Well, yeah, but even Jacob, the people who said the government needs to fix it, when the government does something, then they get cranky because house prices are falling. It's like, well, how the hell do you expect them to fix it?
Yeah.
How do you fix a housing market, but a property will only go up?
Mate, most of it's lip service. It's gone, this should change, this should change. By the way, buy all this stuff that I'm selling you. And then everything else.
Buy my book.
Exactly. And then it changes and you're like, I didn't really mean it.
Yeah. So it just seems really crazy. But I think we can probably put hand on heart and say the property party's probably over.
Well, it lags, right? So I can't remember the name of the company that does all the research, but
Totality.
That's it.
Yeah.
That's the one.
Yeah.
Where they've come out with 9 or 10% premiums coming off in Melbourne and Sydney now.
Yep.
Mostly Melbourne, but we know that they're 2 or 3 months behind with their data, right? So it could be more like 15, 20%, and that's not being unrealistic.
Yeah.
That's actually on the market right now.
Yeah. Well, the other thing is too, I think a lot of people, as I said, when people lose money, they don't rush out on Twitter and announce, hey, we just lost 150 grand. People just sort of like, oh yeah, we decided to sell. They don't sort of go, and we copped a loss of, 200,000. So now we're on rice and bread for, 6 months while we try and pay it down. Right. But it's just, as I said, it's just interesting. I think that the theme is the idea that, everybody's thinking short term. And that to me is a sign that nobody's actually thinking about long-term valuation. Right? Who cares about Cape at 41.5 when I can just jump in on SpaceX and, do 20% a week, which, by the way, is now back to where it was.
Yeah, well, your mate's not a trillionaire anymore.
No, he's only got 997 billion, I think.
Shocking.
Oh, poor bastard. We should send him. We should do a GoFund.
You thought you had a bad week.
So we should send him bread and rice.
I will say, I was looking at it today and went, oh man, there's 80 grand's just disappeared. Look at poor old Elon.
I know.
Right, he's looking at it going, there's 800 million's just disappeared. 80 million.
Bread and rice, Elon.
Easy come, easy go, lads.
I wanted to show you both this. So I've got a Strait of Hormuz tracker. Right, so going back to probably 5 minutes.
What do you track?
ago,
Did you make that?
The ships? No, I didn't make. Well, I might make one though.
How many ships have you done there?
Usual at its peak is 100. At the minute, it's been the 60-day normal.
Yep.
It's at 39 today in the last 24 hours.
39 ships.
39 ships.
Yep.
And there's 285 vessels waiting to go through.
Yeah, to go through. But one guy asked a very good question, which was, how many are actually going in?
Yeah, well, there's more, plus or 12 today. So 95 tankers, 120 bulk carriers, and 70 other, whatever that is.
Yep.
So that's 12 more going in today and just waiting.
Right, okay. Because I see the insurers, I saw something this afternoon, I didn't get a good look at it before I came in, but I think the insurers have sort of come back into the market and said, okay, we'll
start looking at it again.
We'll insure you again. But there's going to be all sorts of fights about it.
Well, 40 is not enough. 24 hours.
Nowhere near enough.
But yet the price is down from 110 to 70. It's just it's illogical. Markets aren't logical. We know that.
Yeah.
It's irrational, mate.
I know. I just think it for those people out there who are going, oh my God, look at my oil stocks. My argument is, don't worry too much.
Just rebalance. Yeah.
Well, again, don't think short term, right? You didn't buy it to. But the hard part is, you make a quick 30%, right? And you think, this is great, and then it disappears.
Well, we know people make decisions to act on based on like reaction and volatility.
Yeah.
So no one really goes, oh, I wonder what's going to happen in 30 years. It just does. It's not real.
Yeah.
But if something happens overnight, you go, oh shit, I've got to sort my portfolio out.
Yeah.
Because it's down 20%. Like, oh, I need to do it. But then if it stabilizes, they go back to
what if it drops more though? Like it's all those intrusive thoughts.
Yeah. So anyway, I thought it was interesting. But so Albo's tax changes have gone through. You talked about it briefly about the property party being over, but there was something that came out, I think it was yesterday, today's Thursday, where now, and I don't know it to its extent, but if you die now or if you get divorced, the capital gains tax disappears.
Yeah.
I don't know enough.
No, the discount. You lose
Capital
the discount.
Gains, yeah, discount disappears, sorry.
So don't die.
Don't die.
That's mine. Not advice.
And don't get divorced.
As Tom says, not advice.
Till next year.
Till July 2nd.
There'll be some couples going, I was thinking about giving him Oro the flick.
Yeah.
I can't do that now.
Next financial year.
The best thing you could do is probably, not advice again, is burn it down. Go the insurance route.
That's definitely not advice.
Well, yeah. Hey, you got to look at all options, right? But
Steve's had 4 house fires.
Yeah, it's really true.
Yeah.
Kids losing his house.
But it's just, that was, all the property gurus were on Twitter, were on Instagram. It's like, okay, buy it in your self-managed super fund. And then Albo just cuts them off at the knees, right? And I'm telling you, they were really not happy.
So what's the change? Because I don't think I tracked that one.
Well, the idea, you could still buy an investment property in your super fund, right? And Albo went, no, you can't.
So
we're stopping that.
So you can't buy any property, or is it just the tax?
No. You can't buy in. Well, the investment, the super funds are now, because super funds have tax advantages.
Yeah.
Right? That's why you put it in super. Well, no, not anymore.
Right.
So again, it just basically blows it out of the water.
So everyone that pivoted, and I won't name names, to buy property in super now are scrambling.
Yeah, are now, got to revisit it, shall we say.
Yeah.
But never fear, mate. Hendo to the rescue.
Yeah,
company structure, bro.
He'll figure it out.
Hendo, get in there. And his fees are going up too.
Oh, no wonder he's got less clients.
I know. He texts me. In the middle of the night. Hi, Steve. And he said to me, I should read it. He said to me, it was actually quite strange. And I'm a little bit worried about Hendo. Right. Because Hendo said to me that, things were not looking good. But then the next day I saw him on Instagram and things are great.
Things are amazing.
Right? Yeah.
But the other big problem is the discretionary trusts as well.
Yeah, that's right, yeah.
So before you could get away with it, you could go, all right, if your wife stayed at home with the kids, you could pay her and keep her under the minimum tax rate and distribute funds to kids or whatever. But now it's just flat 30%.
For everything, at any amount.
So there's less loopholes.
Yeah. But superannuation from a stock market and shares perspective is still a longer term a good thing to think about.
Yeah, superannuation is going to be in sort of, I think, high demand. But I think it fits in with the idea of what we've talked about with the new normal. The government want to reduce liquidity and the speculation, right? And so the super is really great. The only problem is once you put it in, it's really hard to get out, right?
Yeah.
So that's, makes it kind of different.
Well, it changes the strategy, right? Like there's
a little bit, yeah.
Much longer term, look at your asset allocation, but it just changes rather than thinking, it almost forces people to not think short term and get all frantic about it.
Yeah, the problem with super is for guys like you, it's 35 years away for you guys.
Yeah, but if we play it right now,
exactly,
it can make a huge difference.
Yes, absolutely.
If we don't ride all the waves.
Yes. Yeah. You can, if you, and this is the point we're trying to say to sort of people at the moment, given the valuations and given the sort of, the decline, shall we say, in property investing, young guys like yourself should really be thinking about the sort of Well 3 stuff and superannuation. Because, as I say, there's plenty of people who at 50 and at 55 go, oh, super, right, yeah, super, oh my God, like I've only got 300,000, right? And then they're frantically trying to put money into it because they haven't thought about their retirement, right? And if you do that at 30 and say, okay, well, what's a good strategy for the next 30 years that's really simple, right? And I don't have to knock myself out. I just have to pay attention to it, occasionally and make more money. Well, this is why I say if you do that now, you guys might get to 55 and go, hey, I can retire now because I can access my super early because I've got enough money to do that.
It could be the difference of retiring with 600 grand or 2.5 mil.
Absolutely. And I don't think people realise that because it's so far away, you just can't really envisage it.
And the thing for me is it's a decision or two a year. The difference between $500,000 and $2.5 million is a couple of decisions a year.
Yeah, absolutely.
And
it's having the right strategy, right?
Asset allocation.
Absolutely. And importantly for super, asset allocation and the rebalancing.
Yes.
Right? They're the two main things. So what do we got there?
Well, we've got a bit of an insert on super. So, I think I've put a video out today on like the steps to check around your superannuation. And it starts really with just checking it. Like, how often do you check it? When was the last time you looked at it? Just because you've got a monthly contribution doesn't necessarily mean you have to always invest it every single month.
Yeah.
And this is not necessarily talking about get a self-managed super fund. It's more so just going, okay, this month, usually most people that earn higher than the minimum wage, let's say, add additional contributions. And just straight in out of for the tax benefits. It might not necessarily be the right thing to do though.
Yeah.
Especially if you over invested in something like US equities.
Yeah, 100%. That's the thing where I asked someone today, I said, a friend of mine, and I said, we've got to talk about your super. She didn't really know, oh yeah, my accountant does all that. And she's got a self-managed super fund, right? But it's sort of like, okay, are you paying attention to this? Because, if you look at it and go, okay, how would you feel if your super went from 300 to 150? And it'd be like, that's terrible. It's like, okay, well, that's totally possible with the Cape at 41 and global markets going crazy. And, your fund managers probably piled you up on SpaceX.
Yeah. And look, over the course of 40 years, that could happen twice.
Oh, 2 or 3 times easily.
Or it could not happen at all. And that's the difference between what Tom was saying, your 600 or your 2.5.
Exactly. Right. If you pay attention now, you don't see the benefits later on. Yeah, Tom's just moving into a growth fund, right? Which is the next point, right? Check what your allocation is. The argument is, you guys are young, you should just be in growth stocks and keep buying them, right? And as we've argued before, that's not the way to do it, right? Particularly if the Cape's at 42 and, historically we look at it and say, well, pick a year or 2 years or 10 years, but the market will probably lose a lot of money.
Well, you got to remember, super funds are also incentivized to put people into certain ETFs in countries.
Yeah, absolutely.
They're so incentivized to do that. And usually it's the growth techie stuff that incentivizes funds to do that.
But the thing is too, Jacob, what happens is you go, hey, my super's doing all right. And you look at it and go, yeah, they bought the Mag 7, right, for the last 5 years, which is cool. But the only problem is they never sell the Mag 7. They and of course they all get smashed, and then you look at your super and go, man, that looks awful.
And they go, we couldn't have told you.
Yeah, no one could have seen it coming. Or the old, it's all right. Over the long term, just keep buying stocks. It's like, oh God, the thing, super's been in now for about 30 years, roughly around 30 years, right?
Where are the millionaires?
Where are the millionaires, right? Where are all these people who invested wisely or had fund managers invest wisely and get the, quote, 8% annual return, right? Where you look at it and go, hey, okay, 8 nines are 72, so every 9 years you should be doubling your money. Right. Well,
that hasn't been happening.
I haven't seen too many people at the local shopping centre go, "Oh my God, I'm so glad I'm a millionaire from superannuation."
No, you're right, and it's the properties that have done that have made people wealthy. So and because of the growth that we've had there over the last couple of decades, but I've never spoke to someone that said, "Yeah, I started investing 30 years ago and just in stocks."
Yeah,
and now I'm really wealthy.
You know, that was the right decision for me.
Yeah.
And that's why I say, you know, the Australian market hasn't done much since the GFC, but fund managers have done okay. But and that's not a criticism. But the predominance is because they've been in US stocks.
Yes.
So I had a look at an ETF during the week. Someone sent me and said, this ETF's done, you know, quite well. It's focused on value, right? What was it? Value and a couple of other quality and that sort of criteria.
They're all the right words.
Yeah, and then you go in and you look where the money is.
SpaceX.
Right? And it's like 55% tech.
Dogecoin.
Right? And you sort of look at it and go, I think that might be a little bit heavily weighted, you know, and you wouldn't be arguing tech stocks are good value.
Oh no,
right?
They're such a house of cards. That's the thing that worries me the most. It's like maybe if those indexes were weighted evenly and we're looking at these valuations, someone could potentially convince me that nothing catastrophic's coming.
Yep.
But when you look under the covers, you go, oh.
Yeah. And so
yikes.
Think when you go in and look at your super, look at your asset allocation category. Are you in growth or balanced or conservative, right? And just you know, we're not saying do what to do, but just think about, is it a good time to be in growth when growth have killed it for 15 years and the Cape's at 42 and the market's crazy and everyone's buying SpaceX and, you know, everyone's drunk at the wheel. It's like, okay, right?
We'll drill down into it because, I mean, you can argue, not necessarily argue, but there's a lot of growth in things like energy as well, like newish companies coming out. This doesn't have to just be growth tech. It could be growth something else, but just be conscious.
Yes. And then last step is, the important thing is to go through what happens if, right? And the thing with super, which is a little bit strange, you can have a large decline in your super, but because you're not paying attention to it and you can't get at it, you generally tend to sort of ignore it. You know, like you're obviously disappointed, but you tend to sort of like, oh, well. And the reason why is because it's like, oh, well, like I said, for you guys, it's like, oh, well, it's 35 years away.
Yeah.
Right? But it can make a really big difference because if you get the compounding or the sequence of returns right, the compounding, like you said before, Tom, instead of a mil, you get 2.5, right? And you get that because you invested when the Cape was 10, not when the Cape was 42 and lost half.
Yeah.
Right?
And to drive your point, Jacob.
Drive it.
You don't have to have a self-managed super fund to do some of this stuff. I think I'm with ART, for example, and they will let you play around with the weighting.
Yeah, most people do that.
Like you can't get that granular. Like I can't go pick stocks, and there's limited options for the bits and pieces. But for the most part, I could go, all right, I want you to be this amount in cash. I want this amount in emerging markets. And I want you to kind of hold on to my money and rebalance quarterly or annually.
Yes, absolutely.
So
it's like running a self-managed super fund now, right? And the advantage of, like I've got self-managed, right? But I've had it for years. But now the super funds, what they do is say, okay, you can go in and select your asset allocation and your ETFs. But the good thing is they do all the paperwork behind it.
Yeah.
Right? So you just go click every year and it's like, cool.
Yeah, I'll go self-managed when Cape's more attractive. But for now.
Yeah. But all I'm saying is there's the paperwork element of self-managed super funds is not too bad. But if you drift out of stocks and, you know, you start buying artwork and properties and stuff, it gets really messy, right? It's really messy. And there's also stuff if you've got it in a trust and all of this sort of stuff. Like that's when you have to actually say, listen, I need an accountant to
you need a decent
sort
accountant.
this stuff out.
But if you're a decent earner and you're putting more into your fund and you're just in ART, for example, like that's you can still manage it.
Absolutely.
Yeah. I'll give you a real life example. I was talking to someone this week and similar topic. He's only got about 60 or 70,000, his words, in his super.
Yep.
And he's like, and I said, well, what happens if it goes down to 40 or 30? And he's like, oh, it doesn't matter. I'm young and I can. But I'm like, no. The starting point then is 30 or 40, not 60.
Yeah.
So that compounded over a couple of decades,
absolutely,
that's half.
Yeah,
probably less.
You're going to end up with close to half less.
Yeah.
Just because, and he's like, oh, I'm 20, 22, 23.
That's what I mean. It doesn't ring a bell.
Yeah.
But you at 63, I'm looking at it going, no way am I copping 50 down.
Well, exactly.
Right? That's not the way it works.
But the point is, it's where you start in the sequence of returns.
Yes. Yeah.
So it's worth looking at, even if you've only got 30, 40, 50, 60, whatever the number is.
Yep. And especially, that's why it's really important to buy low, because if you buy high and suffer a downturn, like you say, it takes you, it can take you 5 to 10 years to get back to where you were. And that means you've lost, a lot of time in compounding. Plus, to make matters worse, if you'd have bought after it's fallen 50, like in the last US bull market, right, from 2009, it's compounded at 14%, right? Well, that's doubling every 5 years, right? But if you bought in 2007, if you bought in 2007, it's been compounding at about 6. Why? Because the GFC smashed everybody's returns.
Yeah, that's how you get the average.
And if you've been listening since the first episode, you should know this.
Yeah.
Yes.
No excuse.
How many episodes are we up to, lads?
39 or 40?
Yeah, almost 140.
Hundreds.
Been a while, hasn't it?
It has been.
We haven't stopped talking about it for 3 years.
Yeah.
So,
we're broken clocks, mate.
You'll be right twice.
Speak for yourself. Righto.
I'm just preempting.
Yeah. Our fame and fortune when the market crashes, and they're carrying us through this quaint street. Maybe maybe we'll get a statue like outside Suncorp or something.
Yeah, that'll be good for the old ego, wouldn't
it? Yeah. Outside the stock.
There's Wally Lewis. There's Jacob Senior.
Oh my God! Look, there's Tom and Jacob. Who's that other guy holding the shield? Oh, there's some football. Don't worry
Steve.
about that.
All right, so let's talk about randomness. There's a good book, Fooled by Randomness, which everyone should read.
Absolutely.
So we might do a bit of a special on it at some point in time. But we spend so much time normalizing things because we crave predictability. Since the dawn of time, we've wanted to know what comes tomorrow. Sun rises, sun goes down.
Yep.
We're all happy.
Yep.
We're going to eat and drink and things like that. So we're trained to not freak out when things are predictable.
Yeah, and the modern societies are now basically about washing out randomness, right? And it's understandable. Like, it's really hard. You imagine if you said every day your work schedule is random.
Yeah, uncertainty sucks.
Yeah, and it takes a lot of mental power, right? Because you'd have to go in and go, oh well, what am I doing today? And you've got to think about that. And it's like, oh, because I thought we were going to do X. And it's like, no, we're doing Y today. It's like, oh, okay, well, hang on. So it's really hard. But I wanted to sort of randomness is a sort of a quaint sort of word for volatility, right? Which is just a quaint word for change, right? And what I wanted to do was just sort of give this thing. I got talking to a few people about volatility who get fearful of volatility.
Yeah.
And what I'm trying to get across is that actually, if you understand randomness, right, and the normal distribution, which we'll talk about one day.
We've done a special on ergodicity. So go and listen to that if you're new.
Yeah. Because what I'm trying to do is say to people, what you actually want volatility, right? Because you actually want the price to fluctuate because you want to be able to take advantage of it. Right, but the first thing is knowing that you do want some volatility, right? Because if you don't understand it properly, you get fearful, right? And you do the wrong thing at the wrong time, right? So generally, this is Buffett with everybody sells at the bottom and buys at the top.
Yeah.
If you understand volatility properly, you get to understand a whole raft of things, right? Why am I holding cash? Why am I investing in uncorrelated asset classes, right? All of this sort of stuff is really important because we're saying, the argument is the finance theory is the market is random, right? And what we're saying is, no, it's not random. I can't tell you when it's going to fall, but I can tell you when the market's this high and this crazy, when I've looked at history, it's never turned out well.
Yeah, well, the way I think about it is if you look at it through a window, then it can feel really volatile and random. But if you look at it through a windscreen over time, then you can pick things out.
Yes,
and you go, well, it's not actually that random over 50, 60, 70 years.
Yeah.
But over a week, then shit, I don't know what's going to happen.
Yes, absolutely. But honestly, I think I could teach people how to invest with one chart. And it'd be one chart of market cycles. Right? The stuff that's tricky is the emotional stuff.
Yeah.
And that's where volatility comes in, right? When volatility strikes, that's when you start, getting more fearful or more greedy, and that's when it gets you into trouble.
And that's where, I don't know about you, Tom, but that's where I felt there's a lot of use out of having a sounding board. Just having someone, so Tom and I basically started investing together, same time, same day, and having each other to go, is this right? Is this wrong? What do you think? Like, that's just because it's a lonely game.
Yeah, absolutely.
Yeah, if you don't have friends or, if they're not interested in this stuff.
Yeah, you're flying blind.
Yeah.
Yeah, it's 10 times more difficult because you've got yourself to be accountable, and that's scary shit.
Well, it is. I can tell you when I started, as I said, making money is absolutely fantastic, but it's so painful when you lose it, right? And you have to be honest and go, man, I was a sucker for somebody else, right? Somebody else, an experienced trader sitting there going, goose head,
thank you.
And I'm going, hey, this is great. I'm getting another bite at the cherry. And it's like, you've eaten the whole cherry and you're still down 90%. As you can see, it's some other guy sitting in the Bahamas, right? Looking at the fluffy drinks.
Yeah.
So, but in all seriousness, if you, as Jacob said at the start, if you read Fooled by Randomness by Nassim Taleb, it's really, really important because if you get to understand the way the market works in statistical terms and in distribution terms, it's half the battle. And as we say in our courses, what I'm trying to do is say to people, you've got an emotional brain and a logical brain. I'm going to give you the information in the logical brain, right? But the problem is that kicks in second. So what I'm trying to do is say to people, I'm going to give you the knowledge. So eventually it overtakes the emotional brain. And when you get volatility, it's like, cool, okay, I know what I'm doing. Yep, this is fine. Rather than not knowing and then you get volatility and then you freak out. Right? You've got to have that knowledge because then you can go, like Warren Buffett, right? You just look at it and go, another market cycle. Yeah, cool, seen all this before. Oh, look, 10 worst days. Oh, 10 best days. Oh, there you go. Yeah, cool.
And most people are not genuinely, because the thing I've come to learn in this game is that people think they're going to run out of time.
Yeah, it's a weird one,
And the older people get, and that's true, everyone runs out of time eventually, but most people are looking at this now because there's so much technology and things around earlier and earlier and earlier.
Yeah.
And you can be 20, 25, 30 and you can go, hold on, Bob, you're not going to run out of time. Like the world's not going to end in 2 years.
Yeah.
But everything else is instant.
Yeah.
You want to watch a movie, it's instant.
Yeah.
You want to order food.
Well, the other thing is too, Tom.
That's true. Yeah.
The other thing is too, those apps are geared. This was one of the complaints about the investment market in the US, right? Those apps
have gamified it.
Are gamified them, right?
Yeah.
Or they're, it's like an addiction, right? And that's where, it's really
so
really
easy.
Ugly stuff.
I mean, I won't name names, but you go on some of these investing apps and you get, it's like a betting app. And you put $100 in, they give you 100 to spend. It's crazy shit. Like, it's crazy.
Yeah, absolutely. That's what I mean. That's why I say everybody's speculating, right? It doesn't matter if you're rich or poor or young or old. Everybody's got something that they're betting on.
Yeah.
And I don't think we're looking at it collectively going, guys, should we like pull up a little bit here? Like everybody's just manic trying to get rich quickly and nobody's actually taking a breather to go, oh, maybe we should just, chill out a bit here.
Do you think stocks could become the thing if property becomes harder?
Here, you mean?
Yeah.
I think they'll be better. I mean, I don't think that's a push. I don't think property goes anywhere for a decade. No property market has sustained 10 to 11 times income. I don't give a damn about population or any of that stuff, right? And the government, as I say, when John Howard sold Telstra, right, and put it on the stock exchange, I remember this because my brother said to me, I'm going to buy some Telstra. And it was the second tranche was, I think, $7.
Mm-hmm. Hasn't done well.
It's never gone back to $7, right? But I said to people, well, why would you buy Telstra when the government is selling it to make communications cheaper, which means Telstra won't actually make that much money? And there's competitors that the government are favouring because they don't want Telstra to have the whole market, right? So the argument is, okay, well, why would you buy a property if government for the last 12 months to 2 years has been saying we're going to have to do something about this?
Yeah. Or
people have been saying we're going to have to do something about this. So my argument is you have to look at it and say, okay, Albo and Chalmers are saying no more capital gains, tick. Negative gearing limited, tick. Self-managed super fund, tick. Guys, I think they're sending us a message.
Yeah, they're pulling the incentives away.
Yeah, absolutely, Tom.
Well, we've got to wait until your point.
It doesn't help the people who already have 70 rental properties.
Yeah, well,
they can still hang on to them, negative gear them.
Yeah, that's true. But I think everybody gets used to the way their lifestyle is. So you can see. I can see on Instagram all these guys going, what's that word, Jacob? There you go.
Apocalyptic.
Yeah, they're going that way because
I like how I've been.
They're apocalyptic. Their income has just been severed, right? Because nobody, 99% of people hopefully will be saying, oh, well, that's the end of property. Yeah. Well, that means every buyer's agent's gone, uh-oh. Right, every real estate agent's gone, uh-oh.
Good.
Right?
Honestly, good.
I know, but you see what I mean? Like,
except for our mate at Atlas.
No, we've got some good mates.
Yeah, but what I'm saying is, like buyers, agents and property spruikers are the ones who are going, this is really bad, right? Because the ones we talked about, they've been making heaps of money, right? But it's different. It's different when you say, yeah, I've got lots of money, but it's different when you go, okay, people have got lots of property, but it doesn't necessarily mean they're positively geared, right? And if they're earning an income of $300,000 to $400,000 a year by flogging the property, they're a buyer's agent or, they're flogging property courses or stuff like that, well, that's okay because the 300 to 400 covers the 250 they're losing. Right, in negative gearing, so they're paying it down. But when you take away the 300 to 400 in income and say, okay, listen, Bob, you're not going to get 400. Now you're going to be lucky if you get 100. That's where Bob goes, actually, I can't hang on to all these properties. Bob becomes a seller in a market where everyone else is selling.
Well, Bob also doesn't have 10, 15% capital gains
either.
Yeah, which is the important thing.
So that's where, I think there's going to be quite a bit of pain. And from that, yeah, Tom, I think stocks will do better anyway because we've got commodities. Our market's overvalued, but it's not terrible, right?
Yeah, barely.
Yeah, Cape's like 20, 21. It's not too bad. It's not 42, right?
Well, people, and we've mentioned this a bunch of times, people like property because it's leveraged, right? So you can't necessarily go to the bank and say, I've just made 300 grand. Please give me another $1 million because I want to go in stocks. They're going to tell you to get stuffed.
Yeah.
So it begs the question, where do people put their cash? Because they're going to, based on everything we've just talked about and the recency bias and things like that, people want to put their money somewhere.
Yeah, I think there'll be a couple of things. One of the arguments was that people will put more money into their PPR, right? Their principal place of residence. So you make 300 and you go, okay, we're going to put in a pool and a new kitchen, right?
Yeah.
But my argument is, okay, do you want to do that if your property is actually not going to be worth more in 10 years? Do you know what I mean? Like the assumption rolling through is, we'll just put it into the PPR and we'll make more money when we sell it whenever because it's our PPR.
Yeah.
But my argument is, okay, but you want to make sure that you get that 500 grand back. And if property prices don't go anywhere for 10 years, you've just spent 500 grand into a property that you're not going to, compound it out of.
Yeah, yeah.
Right. So that's where I think again, properties become really it's not unattractive. It's like stocks, right? What we're saying is stocks are really expensive. You just got to be selective, right? And you've just got to be more laser focused. You've got to be more patient. You've got to sit on the sidelines. You've got to make low ball offers, right? And some fool says, yeah, I'll take it. And it's like, cool, right? But the days of just buying property and going, hey, just buy anything, we're going to make money. It's like, nah, that's over.
Yeah.
Right? And, look, it's like a normal cycle, mate. The same thing happens in stocks, right? Everybody makes a heap of money and then the market crashes and there's people screaming that it's all rigged. And
it's just an interesting one to chew on because people have the margin bug. It's like a sugar hit of margin. It's so easy to access nowadays.
The banks will lend.
Well, that's what I mean.
Yeah.
So until they stop, and we talked about this loads of times, like until they stop, I think it'll just continue. Whether it's commercial property or residential property or otherwise.
Well, if we get a recession, then, oh dear, all bets are off.
Yeah.
Because that's when it gets really ugly, right? Because no one borrows in a recession. So anyway, we'll see how we go. What do we got, fellas? What's your edge?
We were talking about Munger.
What are we talking about? Charlie?
Yeah, I mean, look, we've talked about, we've got recency bias and priming bias that we want to cover.
Yep.
So recency bias is when we make decisions we are influenced not by the bulk of history, but by more recent events. And I'm reading this word for word, so I'm getting it right. So we've just talked about, basically we've covered that for the last 40 minutes or however long we've been talking now. Things happening right now, people making decisions now in the volatility.
Yep.
And it's really hard unless you have experience. And it goes to a podcast we did a couple of weeks ago on what actually is it, because you can have experienced people that also make wrong decisions based on recency bias.
Yeah. Yep, absolutely.
So how does recency bias impact decisions now?
Well, because it's, again, what we talked about is about randomness, right, and predictability. I can generally, if I followed you around last week, I could generally get the vibe about where you are at certain points in time.
I thought there was a bad smell.
There you go. So what I can do is if someone says to me, it's 11 o'clock Wednesday, and I can say, okay, Jacob will probably be at his office. Right? Why? Oh, well, because he was there last week. Right? He was there recently.
Yep.
Right? And so what you find, and that's how you get momentum, right? Oh, the market should go up. Why? Well, it went up last week. Right? The Cape's at 42. Oh, yeah, but the market's all right.
You do expect it.
Yeah, it's still going up, right?
After.
And like I say, looks like a goose until it starts falling. And that's when then you get the flip side, which is the recency bias says, don't buy into stocks, it's terrible, right? Why? Because they went down last week.
Well, it's recency bias on property right now.
Absolutely.
Every single ad on social is property's down 2%.
Absolutely.
Well, I must say on that note, and I think you pointed this out to me pretty early on, like you really have to completely internalize that you don't get to control the stock price just because you want it to go up.
Yeah.
Like you have to fully get it.
Absolutely.
Like no one can tell you with 100% certainty what it's going to do Monday, Tuesday, Wednesday, Thursday, Friday, and you really have to get it.
Yep.
What you can do is you zoom out far enough and you go, I know over the next period, it's likely to do the thing.
Yep.
But once you really get that, the day-to-day just becomes noise.
Yeah, absolutely.
When you have a green day, it's like awesome.
Yeah.
But also like don't get too elated over that.
Yeah.
Because
there'll be a down day, and you just shrug your shoulders.
Yeah.
And that's why the valuation stuff, like CAPE is a 10-year indicator, right? So that's why the valuation stuff is really important. Because like we were saying off air, I don't know when it crashes. I don't know what crashes it. But I don't need to know that, right? Because I've got lots of cash, I'm hedged, I've got uncorrelated assets, so I don't need to predict, right? You need to predict when it's really critical that you're right.
Yeah.
Right, but that's why we're going to talk about the anti-fragile portfolio. But because what you want to do is you want to have a portfolio which doesn't rely on prediction, right? And that's why the mathematics is really important, and it's really, really simple, right? It's just a matter of adjusting your asset allocation. Hey, the market's really expensive. Oh, okay. The earnings yield is really low. Oh, okay. Look at history. Oh, it's all been really awful. Okay, I should have a lot of cash.
Yeah.
I'm not saying, hey, Cape 42, look, it's going to crash on Wednesday at 7 o'clock. I'm not saying that. I'm saying, look, historically, this is really not good. I'm not making a prediction. I'm just setting my portfolio up for whatever happens.
Yep. Yeah. Right. And if we pull a Japan and go to Cape 100, you've still got some money in there.
Absolutely.
And you'll be peeling it off on the way up anyway.
Right.
Well, the need to be right is an interesting one. The need to be right is it's a personality type for types 3s particularly.
Yeah.
So and a lot of people who invest are type 7s, type 3s or close to it.
Yep.
So it's hard to be that person. Intrinsically, you are that person and go, well, I might not be right. Because I need to be right.
Yeah.
You can be right about knowing that you can't be right.
Yeah.
Yeah.
Thanks, mate. I feel so much better.
And you're all right.
I think he's just saying you're an idiot.
Thanks, mate.
I think I said I was an idiot.
But I've done that. I've done that. I do that lots of times where I say, market will probably go down today. Yeah, it'll go down today. And then it goes up. Right? And I think to myself, Stephen, you were completely wrong.
And Jacob would have probably just said the opposite of you, just to be the opposite and got it right.
Just to be contrary and got it right, and sold into it.
Yeah.
But and the other one I wanted to talk about was priming bias, right? Because they're like, oh God, I've never seen SpaceX so primed, right? With the media, like, data centers in space and we're going to Mars, and he came out with some garbage today about matter and antimatter and stuff. That's why I put that stuff on the socials about Elon Musk, right? Because every time he predicts stuff, he's wrong, right? But what he's doing is he's priming. And the AI boys have been doing this well, right? They're priming people to buy the stock.
Yeah, they're priming retail investors. It happens time and time again.
100%.
It's the same as John Howard selling Telstra into the market. They're priming retail investors into how great it's going to be.
Absolutely.
And it's just liquidity.
Yep. And it's, that's what you've got to be really, really careful about, right? Because, again, you get emotional.
You got Tom.
And it's a real problem.
Go on.
Oh, I don't know if that's a real quote. I've just got...
What do you got, Tom?
Surely he didn't say this.
Who is it?
Musk, but look, the source isn't necessarily credible.
Right.
In the future, $1 trillion times $1 trillion will be spent on making antimatter to travel to other star systems. Yeah. For context, $1 trillion times $1 trillion is 10 to the power of 24. A septillion.
Yeah. That's what I mean. There was some video about matter and antimatter and stuff. I mean, seriously, people have got to get a handle.
Do you reckon he'll be the first septillionaire?
Probably one of his 58 kids.
Well, hopefully.
Probably, actually.
Hopefully, Elon will be the first person living on Mars.
On his own.
and gentlemen, I think that's where we should be.
Let's leave it there. All right. Well, we'll see you guys next week, all right?
All right. Cheers, folks.
Thanks for listening.
This podcast is for educational purposes only and doesn't consider your personal circumstances. Total Money Management Proprietary Limited holds AFSL 568642.